Something shifted in the precious metals market over the past few weeks. If you've been watching gold and silver, you've seen the pullback. Sharp, sudden, uncomfortable if you weren't prepared for it. But here's what matters more than the price movement itself. What it tells us about where we are in the cycle. And more importantly, what it doesn't tell us. This isn't a video about panic. It's not about predictions. It's about pattern recognition. It's about understanding what typically happens when financial markets face the kind of structural pressures we're seeing right now. And it's about thinking clearly when most people are reacting emotionally. If you hold gold or silver, this message is for you. If you've been considering these assets but haven't yet taken a position, this message is also for you. Because the next several months are likely to separate disciplined investors from reactive ones. Let's talk about what's really happening. Gold recently pulled back from highs that took years to reach. Silver, which tends to move with more volatility, declined even more sharply in percentage terms. The headlines called it a correction. Some called it a crash. Others suggested the bull market was over. None of those descriptions capture what's actually occurring. What we witnessed was profit-taking combined with technical positioning. Leveraged traders who had pushed prices higher took profits. Momentum algorithms triggered sell signals. Short-term speculators who entered late got shaken out. This is textbook market behavior during the middle stages of a structural bull market in hard assets. But the macroeconomic conditions that drove gold and silver higher in the first place haven't changed. In fact, several of them have intensified. That's the disconnect most people miss. They see the price drop and assume the thesis is broken. They don't understand that in long-term bull markets for assets like precious metals, sharp pullbacks are not anomalies. They're features of the journey, not bugs in the system. Let's step back and examine why gold and silver were rising in the first place. Global debt levels have reached historic proportions. Government debt, corporate debt, household debt, all at levels that would have been considered catastrophic just 2 decades ago. The United States alone carries debt exceeding its annual economic output. Other developed nations face similar or worse ratios. This debt cannot be repaid through traditional means. The mathematics simply don't work. The only viable path governments have chosen, repeatedly and consistently, is to manage this debt through monetary expansion and financial repression. What does that mean in plain language? It means printing more currency. It means keeping interest rates artificially suppressed relative to inflation. It means slowly eroding the purchasing power of cash and fixed income assets to make debt burdens more manageable. This isn't conspiracy theory, it's documented policy. Central banks have stated these objectives explicitly in their communications. They call it inflation targeting and accommodative monetary policy. The effect is the same: currency debasement over time. Gold and silver respond to this environment because they represent forms of money that cannot be printed. They are finite resources with production costs and physical constraints. When confidence in paper currency systems begins to waver, even slightly, these metals tend to attract capital-seeking preservation. That's the fundamental backdrop. And nothing about the recent price pullback changes any of that. Here's where psychology enters the equation. When an asset rises steadily, people feel smart for holding it. When it pulls back sharply, those same people question their entire thesis. This emotional whipsaw causes more wealth destruction than almost any other factor in investing. The reality is that all significant bull markets, in stocks, commodities, real estate, or precious metals, are punctuated by brutal corrections. During the gold bull market from 2001 to 2011, there were multiple pullbacks of 20% or more. Investors who sold during those corrections missed the continuation of the trend. Those who understood the macroeconomic cycle and maintained their positions were rewarded for their patience. We're likely seeing something similar now. The difference is that today's macroeconomic imbalances are larger, more complex, and more global than they were during that previous cycle. Consider the coordination among central banks over the past several years, unprecedented monetary stimulus, balance sheets expanded to levels no one thought possible, interest rates pushed to zero or below, then rapid rate hikes to combat the inflation that stimulus created. Now, uncertainty about whether rates can stay elevated without breaking something systemically important. This is the environment in which gold and silver tend to perform best over multi-year timeframes, not in a straight line upward, but in a pattern of advances, sharp corrections, and resumed advances as the underlying monetary pressures reassert themselves. Let's talk about how these cycles typically unfold, because understanding the pattern helps you maintain perspective when volatility strikes. In the early phase of a precious metals bull market, prices rise but few people notice. The moves are steady, but not spectacular. Media coverage is minimal. Most investors remain focused on traditional assets like stocks and bonds. In the middle phase, prices accelerate. More investors take notice. And there are sharp rallies followed by sharp corrections. This is where we separate long-term holders from short-term traders. The corrections shake out weak hands. They test conviction. They create the volatility that eventually leads to the next leg higher. In the late phase, prices go parabolic. Everyone is talking about gold and silver. Your neighbors are asking how to buy them. Media coverage becomes saturated. This is when disciplined investors begin taking profits and reducing positions. Where are we now? Most indicators suggest we're somewhere in the middle phase. Prices have risen enough to attract attention, but we haven't seen the mania characteristics of a blow-off top. The recent correction, as painful as it felt, is consistent with mid-cycle behavior. History doesn't repeat exactly, but it often rhymes. And the rhyme pattern here suggests we're not at the end of this cycle. We're in the turbulent middle. Let's ground this discussion in observable facts rather than speculation. Central bank gold purchases have remained elevated. Central banks around the world, particularly those seeking to reduce dollar dependence, have been consistent buyers of physical gold. This represents structural demand from the world's most sophisticated monetary institutions. They're not buying gold because they predict short-term price moves. They're buying it as strategic reserves against systemic monetary risk. Mine supply remains constrained. Gold and silver production hasn't kept pace with demand. New mine discoveries have declined. Existing mines face rising costs. This supply-side constraint creates a floor under prices over the long term, even if short-term volatility remains high. Inflation expectations remain unstable. Despite central bank efforts, inflation has proven stickier than anticipated. Real interest rates, the difference between nominal rates and inflation, remain low or negative in many regions. This environment typically supports precious metals valuations. Currency instability has increased. The dollar's role as global reserve currency faces gradual erosion, not through dramatic collapse, but through slow diversification by other nations. This multi-year trend supports demand for non-sovereign monetary assets. None of these factors disappeared because gold and silver corrected. The fundamental case remains intact. If you purchased gold or silver based on the macroeconomic thesis we've outlined, the recent pullback is not a signal to exit. It's a test of your understanding and conviction. Ask yourself, why did you buy these assets in the first place? If your answer was to preserve purchasing power over years or decades, then short-term price volatility is irrelevant noise. If your answer was to speculate on quick price gains, then you may have misunderstood what these assets are for. Gold and silver are not get-rich-quick vehicles. They're insurance policies that sometimes appreciate significantly. They're stores of value during periods of monetary instability. They're portfolio diversifiers that behave differently than stocks and bonds during certain market environments. The most successful holders of precious metals think in terms of cycles, not weeks or months. They don't check prices daily. They don't panic during corrections. They understand that the path to wealth preservation is rarely smooth, and that volatility is the price you pay for protection against monetary degradation. Your biggest risk right now isn't the price pullback. It's letting short-term volatility shake you out of a position before the underlying thesis plays out. That said, position sizing matters enormously. If you're losing sleep over price movements, you may own too much relative to your risk tolerance. Disciplined investors allocate to precious metals based on their overall financial situation, not based on current market sentiment. For those who have been considering gold or silver but haven't yet taken a position, the recent pullback might feel like vindication. You avoided the decline. You feel smart for waiting. But here's the challenge. If you didn't buy before the correction, will you buy during it? Or will you wait for prices to rise again before feeling comfortable? Most people operate backwards. They want to buy after an asset has already proven itself by going up. They feel safer buying at higher prices than at lower prices. This is one of the most reliable wealth-destroying patterns in investing. The question you should be asking isn't, what will prices do next? The question should be, do I believe the long-term macroeconomic case for monetary metals? And if so, am I willing to accept volatility as part of the process? If your answer is yes, then corrections like this represent opportunity, not danger. If your answer is no, then you shouldn't own these assets regardless of price. Consider this. The investors who accumulated gold between 2001 and 2003 faced multiple corrections. Many questioned whether they'd made a mistake. But by 2011, those same positions had multiplied several times in value. The key was having a thesis, allocating appropriately, and maintaining discipline through the noise. The same principle applies today. If you believe the structural monetary issues we've discussed are real and will continue influencing markets, then you're not buying gold or silver to trade price fluctuations. You're buying them as long-term portfolio positions that serve a specific risk management function. Let's talk about what happens to investor psychology during corrections, because understanding this helps you avoid the mistakes that derail most people. When prices are rising, confidence builds. People who own the asset feel validated. People who don't own it feel fear of missing out. This emotional state leads to poor decisions, chasing prices higher without understanding the underlying asset. When prices correct sharply, emotions reverse. Holders feel fear and regret. Non-holders feel relief and vindication. Both groups are reacting emotionally rather than thinking strategically. The disciplined investor experiences these emotions, but doesn't act on them. They understand that feelings of certainty at market tops and feelings of doubt during corrections are exactly backwards from reality. They've seen this pattern enough times to recognize it and resist it. This is easier said than done. Our brains are wired to seek patterns and react to immediate threats. A sharp price decline triggers the same neurological responses as physical danger. It takes conscious effort and experience to override these instincts. The investors who build lasting wealth in cyclical markets like precious metals have learned to do several things differently than the crowd. They view volatility as normal rather than threatening. They understand that assets which can drop 20% can also rise 100% under the right conditions, and that you can't have one without risking the other. They think probabilistically rather than in certainties. They don't need to know exactly what will happen. They position themselves for a range of likely outcomes based on fundamental conditions. They separate their emotions from their analysis. They can feel uncomfortable during a correction while simultaneously recognizing that the correction doesn't invalidate their long-term thesis. They maintain excess liquidity so they never need to sell at unfavorable times. This is perhaps the most important factor. Investors who are forced to liquidate during downturns because they need cash will always buy high and sell low. Those who maintain adequate liquidity can hold through volatility and even add to positions when others are capitulating. Let's discuss something that often gets overlooked in conversations about investing: the difference between risk and uncertainty. Risk can be measured and managed. If you allocate 10% of your portfolio to gold, you understand that this portion might be volatile, but the impact on your overall wealth is limited and calculated. That's manageable risk. Uncertainty refers to outcomes you cannot predict or quantify. Will gold be higher or lower 6 months from now? That's uncertain, and no amount of analysis will give you a definitive answer. The mistake most people make is trying to eliminate uncertainty by predicting the future. They watch technical analysis videos promising specific price targets. They follow gurus who claim to know exactly what's coming. They want certainty in an inherently uncertain world. Disciplined investors approach this differently. They accept uncertainty but manage risk. They position themselves so they can benefit if their thesis is correct, while surviving if they're wrong. They never bet everything on one outcome. This mindset becomes especially important during volatile periods like the current one. You don't need to know whether gold will hit a new high next month or next year. You need to understand whether the fundamental conditions support owning it as part of a diversified portfolio designed to preserve purchasing power across different economic scenarios. That's a very different question, and it has a clear answer based on observable trends in debt, monetary policy, and currency dynamics. Sometimes the best investing advice is about avoidance rather than action. Let's talk about the mistakes that destroy capital during periods like this. Don't sell in panic. If you bought based on a long-term thesis and that thesis remains intact, selling during a correction transfers your wealth to patient buyers. The emotional relief you feel from exiting a volatile position will be temporary. The financial cost of exiting near a bottom will be permanent. Don't chase price movements. When silver spikes 5% in a day, that's not a signal to rush in. When it drops 8% the next day, that's not necessarily a signal to sell. Short-term price action in volatile assets creates noise, not information. Focus on the trend and fundamentals, not daily fluctuations. Don't leverage these positions. Some investors use margin or derivatives to amplify their exposure to precious metals. This approach can work during sustained uptrends, but it becomes devastating during sharp corrections. The volatility in these markets is too high for leverage to be appropriate for most investors. Position sizing should be based on capital you can afford to hold through multiple cycles. Don't follow online hype uncritically. Social media has created echo chambers where confirmation bias runs wild. You'll find communities that are permanently bullish on precious metals regardless of circumstances, and others that are permanently bearish. Neither extreme reflects thoughtful analysis. Seek diverse perspectives and think independently. Don't ignore position sizing. Even if you're correct about the long-term direction of gold and silver, owning too much relative to your total portfolio can force you into emotional decisions during volatility. A position that represents 5 to 10% of your investable assets allows you to maintain conviction during corrections. A position representing 50% or more will almost certainly cause you to sell at the worst times. Don't confuse price with value. Price is what you pay. Value is what you get. During corrections, price declines while the underlying value proposition may actually strengthen if the macroeconomic conditions intensify. Learn to separate these concepts in your thinking. Don't stop educating yourself. The worst time to stop learning about an asset class is during volatility. That's when understanding matters most. Read about historical cycles. Study monetary history. Understand the mechanisms that drive these markets over long time frames. Knowledge reduces anxiety and improves decision quality. To truly understand what's happening with precious metals, we need to examine the economic environment we're navigating. Debt levels across developed economies have reached points where conventional solutions no longer exist. Governments cannot significantly raise taxes without crushing economic activity. They cannot dramatically cut spending without political upheaval. They cannot allow interest rates to rise freely without causing debt service costs to consume entire budgets. This creates a trap, and there are only a few ways out of such traps historically. You can grow your way out, which requires productivity gains and economic expansion that seems unlikely given demographic trends and debt overhangs. You can default outright, which carries catastrophic economic and social consequences. Or you can devalue your way out, which means inflating the currency to make nominal debt payments more manageable while real purchasing power erodes. Every signal from central banks and governments suggests they've chosen the third option. They may not state it explicitly, but their actions speak clearly. Inflation targets have shifted. Balance sheets remain elevated. Fiscal discipline has disappeared. These are the hallmarks of monetary regimes that will sacrifice currency stability to maintain financial system stability. In such an environment, assets that cannot be printed or inflated away tend to perform well over time. This includes productive assets like businesses and real estate, but it also includes monetary metals that have served as value stores for thousands of years. The recent correction in gold and silver doesn't change this context. If anything, it provides an opportunity to position for the continuation of these trends at more favorable prices. There's a mindset difference between traders and holders that's worth examining. Traders view markets as profit engines. They try to capture short-term moves. They watch price action constantly. They feel pressure to be right about timing. They measure success in quarterly or annual returns. Long-term holders view certain assets as portfolio anchors. They're less concerned with short-term performance and more focused on what an asset does for their overall financial structure. They measure success in purchasing power preserved over decades, not percentage returns over months. For precious metals specifically, long-term holders understand several things that short-term participants often miss. They know that these markets can remain irrational longer than you can remain solvent if you're trading on leverage or short time frames. But over multiple years, the fundamental forces tend to reassert themselves. They know that the most uncomfortable moments to hold an asset are often the best times to be holding it. When gold pulled back 20% in 2008 during the financial crisis, it felt terrifying. But those who held through that period were rewarded as central banks launched unprecedented stimulus that drove gold from $700 to over $1,200 in the following years. They know that position sizing is more important than timing. You don't need to buy at the exact bottom if you've allocated a reasonable portion of your portfolio based on the asset's role in your overall strategy. They know that the goal isn't to get rich quickly, but to preserve wealth steadily. In a world where currency debasement is policy and financial repression is the norm, preservation of purchasing power is itself a form of significant wealth creation. So where does this leave us? What should a thoughtful investor be thinking about in the weeks and months ahead? First, recognize that we're in a period of transition. The easy money era of the past decade is ending, but we haven't reached true monetary stability. Central banks are attempting an extremely difficult balancing act, controlling inflation without breaking credit markets, maintaining financial stability without reigniting price pressures. This balancing act is likely to fail in one direction or another. Either inflation remains problematic and erodes confidence in currency, or the attempt to control inflation breaks something systemically important and forces a return to loose monetary policy. Both scenarios support the long-term case for precious metals, though the path may be volatile. Second, understand that corrections serve a purpose in bull markets. They shake out weak hands. They reset technical indicators. They create opportunities for disciplined accumulation. The sharpness of the recent pullback in gold and silver suggests that the next leg higher, when it comes, may be substantial. Timing that perfectly is impossible, but positioning yourself to benefit from the likely direction over the next several years is achievable. Third, maintain perspective on what these assets are and what they're not. Gold and silver are not going to 10x next year. They're not going to make you a millionaire overnight. What they can do is protect purchasing power during periods of monetary instability while providing portfolio diversification that becomes especially valuable during certain types of crises. That's a more modest but more reliable role. It's less exciting than the promises you'll hear in sensationalist content, but it's more aligned with how successful investors actually use these assets. If you're considering entering the precious metals market or adding to existing positions, this environment requires careful thought. Dollar cost averaging makes sense for assets this volatile. Rather than trying to time a perfect entry, consider accumulating gradually over months. This reduces the risk of buying at a local top and ensures you're building a position through different market conditions. Physical metal versus paper products matters. If your thesis is based on monetary system risk, owning physical gold and silver you can hold provides different benefits than exposure through ETFs or mining stocks. Each has its place, but understand what you own and why. Storage and security become important if you're holding physical metal. This isn't something to improvise. Professional vault storage or robust home security systems are necessary for meaningful holdings. Don't neglect the rest of your portfolio. Precious metals serve a specific function, but they shouldn't be your entire investment strategy. Maintain exposure to productive assets. Keep adequate liquidity. Ensure your income sources remain strong. A well-structured financial position allows you to hold volatile assets through difficult periods. Think in terms of allocations, not price predictions. Deciding that 10% of your investable assets should be in precious metals is a defensible strategy based on portfolio theory and monetary trends. Deciding that you'll buy gold if it drops to $2,400 or silver if it hits $28 is speculation based on arbitrary numbers. Here's something that often gets lost in day-to-day market commentary. Cycles take longer than most people expect, and they go further than most people anticipate. The gold bull market from 2001 to 2011 took 10 years to fully play out. It included multiple 20% plus corrections. Investors who bought in 2003 and held until 2011 achieved exceptional returns, but they had to endure the several periods where their positions were underwater and media commentary declared the gold rally finished. The subsequent bear market from 2011 to 2015 was equally challenging. Gold fell from over $1,900 to under $100. Investors who had gotten emotionally attached to rising prices experienced painful losses. Those who understood cycles recognized it as a normal correction within a larger secular trend. What we're likely experiencing now is another chapter in this ongoing story. The monetary dynamics that supported gold from 2001 to 2011 haven't disappeared. They've intensified. Government debt is higher. Central bank balance sheets are larger. Currency instability is more pronounced. But the path forward won't be smooth. There will be more corrections like the recent one. There will be periods where holding these assets feels uncomfortable. There will be moments where you question whether the thesis still makes sense. This is the nature of all significant investment themes. They take time to develop. They test your conviction. They reward patience and punish reactive behavior. While we won't focus on personalities, it's worth noting that experienced analysts who study monetary systems and commodity cycles are watching several key indicators right now. Real interest rates, the difference between nominal interest rates and actual inflation, remain a critical factor. When real rates are negative or very low, precious metals tend to perform well because the opportunity cost of holding them is minimal. Current real rates remain supportive despite recent volatility. Credit spreads and financial stress indicators show underlying tension in the system. While we haven't seen acute crisis conditions, the strains are building. Higher debt service costs, stressed commercial real estate, troubled regional banks, these are the kinds of developments that eventually drive capital towards safety assets. Currency depreciation trends continue across many nations. The dollar has shown relative strength recently, but the long-term trajectory of all fiat currencies is gradual devaluation. This isn't doomsaying, it's observable history and deliberate policy. Central bank communication reveals ongoing uncertainty about the path forward. The confidence that central banks projected during the pre-2020 era has been replaced with cautious, conditional statements about their ability to manage inflation without causing recession. This uncertainty tends to support monetary metals. These are the kinds of factors that matter over months and years, not the daily price movements that dominate financial media headlines. Let's address something practical. How do you maintain emotional equilibrium when assets you own are dropping sharply? First, stop watching prices constantly. If you check gold and silver prices multiple times per day, you're programming yourself for emotional decision-making. Set a schedule, maybe once a week or once a month, to review your positions. This creates psychological distance from short-term noise. Second, revisit your original thesis regularly. Write down why you own these assets. Review that document during volatile periods. If the reasons are still valid, the price action is just noise. If the fundamental thesis has changed, that's different. But make sure you're distinguishing between changed fundamentals and changed sentiment. Third, maintain balance in your information diet. If you only consume content from precious metals enthusiasts, you'll develop a skewed perspective. If you only read mainstream financial media that typically dismisses gold and silver, you'll miss important developments. Seek diverse, thoughtful sources and think independently. Fourth, remember that discomfort is not the same as danger. Volatile investments create uncomfortable feelings. That's the price you pay for potential long-term returns and a portfolio diversification benefits. If you can't tolerate the discomfort, reduce your position size until you can sleep at night. And there's no shame in that. It's prudent risk management. Fifth, focus on what you can control. You can't control whether gold rises or falls next month. You can control your position sizing, your emotional reactions, your continued education, and your adherence to a long-term plan. Channel your energy toward controllable factors. Where do we go from here? What should thoughtful investors be doing in the coming months? Continue educating yourself about monetary systems, market history, and macroeconomic trends. The more you understand, the better decisions you'll make, and the less likely you are to be shaken by volatility. Maintain appropriate position sizing based on your individual circumstances. There's no universal correct allocation to precious metals. It depends on your age, income stability, risk tolerance, other assets, and personal conviction about monetary trends. Stay patient. The most likely scenario is that gold and silver continue to experience volatility while gradually trending higher as the underlying monetary dynamics play out. This process takes years, not months. Those who position accordingly and maintain discipline will likely be rewarded. Those who trade in and out emotionally will likely underperform. Keep perspective on market noise versus signal. Daily price movements are noise. Central bank policies, fiscal trajectories, debt levels, currency trends, these are signal. Learn to filter accordingly. Remember that wealth preservation during uncertain times is itself a victory. In an environment where most people will see their savings eroded by inflation and financial repression, maintaining purchasing power puts you ahead of the curve. Here's what this moment really asks of you. Do you understand the difference between volatility and risk? Volatility is fluctuation around a trend. It's uncomfortable, but not necessarily dangerous if you're positioned appropriately. Risk is permanent loss of capital or permanent erosion of purchasing power. The biggest risk facing investors today isn't that gold might drop another 10% from here. It's that currency debasement continues eroding the real value of cash and fixed income assets, while most people remain fully invested in those depreciating instruments. That's the risk the smart money is managing by maintaining diversified portfolios that include monetary metals. Not because they know what prices will do next month, but because they understand what central banks are doing to currency over the long term. The recent pullback in gold and silver changes nothing about that fundamental dynamic. If anything, it's given thoughtful investors an opportunity to position themselves more favorably for what's likely coming. We've covered a lot of ground here, so let's distill this to its essence. The precious metals market just experienced a sharp correction. This is normal behavior during the middle stages of a bull market driven by monetary instability. The fundamental case for gold and silver as portfolio diversifiers and purchasing power protectors remains intact. If you already hold these assets, the pullback is a test of your conviction and understanding, not a signal that you made a mistake. Maintain your positions if the original thesis still makes sense to you. If you don't yet own precious metals but have been considering them, use this period to educate yourself and potentially begin building a position gradually. Don't try to time the perfect entry. Focus on allocation and long-term thinking. For everyone, the key lessons are the same. Think in terms of cycles, not days or weeks. Manage position sizes so you can weather volatility. Separate emotion from analysis. Focus on fundamental drivers, not price action. Maintain discipline when others are reacting impulsively. The crisis some are warning about isn't necessarily imminent, but the conditions that eventually produce crises are building steadily. Debt levels aren't declining. Monetary discipline isn't returning. Currency debasement remains the path of least resistance for policymakers facing impossible choices. In that environment, owning assets that cannot be printed or inflated away makes sense as part of a diversified approach to wealth preservation. Not as a speculation, not as a trade, but as a long-term position that serves a specific purpose in your overall financial structure. The smart money understands this. They're not panicking over short-term price movements. They're positioning for the continuation of trends that have decades of history supporting them. You can do the same by staying informed, remaining disciplined, and thinking independently. The path won't be smooth, but for those who understand what they own and why they own it, volatility becomes manageable rather than terrifying. That's what this moment is really about, separating those who understand from those who are simply reacting. Be the former. Your future self will thank you for it. Stay educated, stay disciplined, and most importantly, stay thoughtful. That's how wealth is built and preserved across market cycles, regardless of what any single day or week brings. Thank you for your time and attention. Until next time.